Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that I recently found in the market that could be presenting a good buying opportunity right now. And that stock is Pure Storage. And this stock is outperforming the market over the last year. They're down only 9% when the rest of the market is down about 17%. And we can also see over the 5-year chart, the S&P 500 is up around 40%, but Pure Storage is up right underneath around 70%. So they are outperforming the market over the long term as well. And so in this video, I'm just going to go into some of the recent news that's come out around this stock and this company and look into their financial statements and figure out if this is a good price to buy into the stock from a value investing perspective. So right here, we can see that this is an article pointing out something that the Pure Storage CEO said in a recent earnings call for the third quarter earnings results for their company. He basically touched on the fact that he thinks that the days of the hard disk in the data center are over. And just for some transparency here, for those who don't know what Pure Storage company is, they basically deliver advanced data storage technology and services, making a business-to-business play, selling to enterprises to try to help companies, especially tech companies, save costs when it comes to data storage for all of their, data storage and memory needs. And so right here we can see he points out that he thinks that customers who don't take advantage of their products to replace disk systems are choosing the more expensive and energy intensive option. And if I scroll down here, we can see he also points out that the focus on all flash storage technology combined with the expected continuing decrease in the cost of NAND storage is leading Pure Storage to have an advantage over hard disk storage technology, which a lot of companies are still using. And on top of that, they actually use an example for one of their customers, Facebook, or also parent company Meta, where they talk about how they shipped offerings for the second phase of Meta's build out for the metaverse. And then they quote right here, he said, as a reminder, our shipments for Meta consist both of FlashBlade and FlashArray//C. And he said that one of their products, FlashBlade, provides lightning fast data delivery to their NVIDIA GPUs. And their FlashArray//C product helps provide performance-oriented, cost-effective bulk data storage at 1/10 the space, the power, and the cooling of a disk alternative. And so you can see the competitive advantage that Pure Storage has over the current products that are in the market is that they take up less space and they require less cooling energy to keep the correct temperature for these massive data storage areas that these big tech companies have, which is one of the biggest expenses that eats into the profit margins of these big tech companies. So if Pure Storage is able to alleviate some of that cost, then that's obviously a lot of value. We can also see right here, AWS, Amazon Web Services, and Pure Storage partnership highlights enterprise interest in application portability. And essentially in this article, they just touch on the fact that Pure Storage allows these tech companies to run their applications anywhere using their portable technology is also something that's a really interesting value proposition for them to make to these larger enterprises that differentiates them from the current incumbent competitors. And so right here we can see the balance sheet for Pure Storage comparing the third quarter of fiscal year 2023 to fiscal 2022. And during that time period, total assets have increased from around $3.1 billion to $3.2 billion. We can also see most of their business is financed by liabilities compared to equity, and they actually have an accumulated deficit here, which points out the fact that Pure Storage is not a profitable company at the moment. And so in terms of operating history, they've mainly only had operating losses, which is why they have this accumulated deficit here, but it has decreased over this time period. And so it's obviously a good trend to see that their accumulated deficit is decreasing, because that means their company could be becoming more profitable. We can also see right here, this is their income statement for their product and subscription services revenue. In total, year over year, their revenues have increased from $562 million to $676 million. So that's an increase of around 20% year over year. Their subscription services revenue alone was up around 30% year over year, which is pretty good because it's a reoccurring revenue line item, so you want to see that line item increasing. However, we can see once we get into operating expenses, they have really big expenses in sales and marketing, as well as research and development, and that's what's mainly eating into their net profit margins here. We can see at the bottom here that In the third quarter of fiscal year 2023, they had a net loss of $787,000, but that is a decrease in losses in comparison to their last year results of around $28 million worth of net losses. So their company is becoming more profitable year over year. So hopefully they'll be able to turn a profit by next year and start eating away at that accumulated deficit, eventually having a retained earnings line item on their balance sheet that they could use to grow the company. And lastly, right here, we have their cash flow statement comparing the operating cash flow of the third quarter of fiscal year 2023 to 2022. And we can see their operating cash flow has increased from $127 million to $154 million. Free cash flow for the third quarter after subtracting capital expenditures was around $114 million. And then in financing activities, we can see they've definitely been raising a lot of money by issuing common stock as a part of their employee stock purchase plan, right here at around $20.5 million. But also we can see right underneath that they spent $24.5 million repurchasing common stock for their company. So that could be an indication that management believes that at the current share price, they believe that the stock is or priced well so that it'll grow into the future, they'll get a return. But either way, repurchasing $24.5 million worth of common stock and $151.5 million through the first 3 quarters of the year is definitely a lot of value returned to shareholders who have been invested in Pure Storage over the last year. So right here we can see this is a discounted cash flow model trying to figure out the intrinsic value per share for the company. And Yahoo Finance is estimating that they're going to grow at around 32% for the next 5 years. And then I was conservative and cut that in half to 16% for the next 5 years after that. They had $340 million worth of free cash flow in the last fiscal year, and around $717 million worth of cash on their balance sheet, and around a little under 300 million shares outstanding. So that puts their intrinsic value per share at $51 per share with a 50% margin of safety of $25 per share, which means that at the current share price, Pure Storage is currently trading near a 50% margin of safety relative to their intrinsic value per share of around $51 per share. And so if they are able to grow at the growth rates of around 32 to 16% for the next 10 years, then that means that at the current share price, they are definitely priced very well to produce around a 100% return at least for their shareholders who buy into the stock price at this current share price. We can also see that on the right hand side here, did a competitor analysis comparing them to some of their competitors, Dell and IBM in particular. And obviously we saw from their income statement that Pure Storage is not profitable, so they don't really have a net profit margin or return on assets, but they do have the highest gross profit margin out of their 2 competitors here, Dell and IBM. And then from a competitor analysis perspective, net profit margin goes to IBM and return on assets goes to Dell. So I would say it would be pretty tough to compare these companies from a competitor analysis perspective. If you only wanted to invest in companies that were producing a net profit margin at the moment, then you'd probably want to prioritize investing in IBM here because they have the highest net profit margin. But in terms of growth capability, obviously Pure Storage is the smallest company on this list and compared to Dell and IBM, so they probably have more room to grow. And we saw with their partnerships with Meta as well as Amazon Web Services that they could be expanding and producing a lot of positive revenues partnering with these bigger tech companies in the future. So from that perspective, not really sure what to make of it, but from an intrinsic value standpoint, it definitely looks like Pure Storage is presenting a good buying opportunity. But I'd love to know what everyone watching this video thinks about Pure Storage. Is it a good buying price or a good buying opportunity at the current share price? Let me know in the comment section down below what you guys think. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.